Hello, this is Patrick Yankee with Yankee Financial here in Raleigh, North Carolina. Securities offered through Raymond James Financial Services. Welcome to this quarter's Capital Markets Review. As always, my purpose is to inform and to answer questions on the economy and the financial markets. This isn't meant to be my prediction for the course of the stock market for the rest of 2018 and beyond. Rather, it's a review of economic and historical data to help investors make informed decisions about their financial futures. Once again this quarter, I have chosen to use slides from the Guide to the Markets produced by J.P. Morgan Asset Management for the simple way they present complex ideas. Most slides have multiple charts on them. I will point out the information I think is most relevant. The opinions expressed are mine and not necessarily those of Raymond James, and J.P. Morgan is not affiliated with Raymond James. This quarter, there are four main themes I want to stress. We'll start with an economic update, talk about interest rates, talk about the equity markets, and then what investors should be doing. I don't have to tell you that last year was a good year in the financial markets. Most portfolios should have gained, and many gained substantially. U.S. markets, as measured by the S&P 500, were up about 22% last year. Overseas assets rose more, boosted by a softening U.S. dollar. This year, we have had a return to volatility. At the end of the quarter, the S&P 500 was just about flat for the year, while most overseas markets were a little more negative. American investors benefited from a softening dollar again, which muted the losses so far. Generally speaking, this year has been a bit of a roller coaster that has so far simply returned to the gate for another ride. Like it or not, the U.S. leads the world economically. When we fall into recession, the world tends to follow. Therefore, it's important to keep up with the U.S. economy even when considering foreign investments. Year-over-year GDP growth was 2.6% in the fourth quarter. And on the right, we're looking at components of GDP. Consumption always makes up the largest chunk in a market-driven economy. Therefore, it's important as investors to know how consumers are doing financially, and overall, GDP growth remains low versus historical rates. These four sectors are considered to be the four horsemen of the apocalypse because they tend to lead into recession and also lead out. The right charts are business-related, and the left charts are consumer-driven. These are areas both can put off when times are hard, and areas that benefit in recovery. The bottom line for all four is that they are not signaling recession at this point. Higher home values help create a wealth effect for consumers. Nothing makes consumers feel wealthier and freer to spend money than having their largest asset appreciate in value. Home values have been on a solid growth trajectory since 2012, and housing affordability remains strong. Note the bottom left chart, though. When you compare current home prices to average incomes, houses are becoming very expensive. This is good for sellers, but tough for buyers. Those who currently own homes are still experiencing strong housing affordability with low mortgage rates reducing mortgage payments relative to incomes, although mortgage rates are rising. When the price of oil fell at the end of 2014, many rigs in the United States were shuttered as uneconomic at the lower prices. These shuttered rigs are available when oil prices rise to economically feasible levels. Consumption has grown at an average 1.4% per year historically. Oil supplies have grown at a more erratic rate. Recently, inventories have fallen with a dramatic increase of demand in China, primarily, and that has allowed the price of oil to rise. Note the chart in the bottom left. The drop in the price of oil with increased inventories brought about the idling of about two-thirds of oil rigs in the United States. The higher price of oil has made it more economical to reopen some rigs already. Because of this, oil will likely remain banded around the $60 per barrel range. In the longer term, the price will likely rise as demand continues to grow at its historical rate while supplies seek equilibrium. Demand will be driven by economic growth, while supply can be somewhat controlled by oil producers. Expectations call for oil production to be greater than consumption in 2018. Generally, when unemployment falls, job prospects have greater leverage in negotiations. This tends to drive up wages. In this economic expansion, wages remain flat despite a significant fall in the official unemployment rate. This shows the softness of the real jobs market. One way we can measure the true level of unemployment is to consider the labor force participation rate. That's the upper right chart. This shows the percentage of the working age population participating in the labor markets. At under 63%, we are still at levels not seen since the mid-1970s, as reported by multiple media outlets. As the economy strengthens, the recent trend has arrested its descent, but it still remains low. Some of the drop in the participation rate is attributable to people leaving the labor force due to aging. Some economists are predicting that the low unemployment rate will keep GDP growth muted. This thinking has some calling for immigration reform as a means to provide a supply of new employment. This is an area where I disagree with those economists. Although the official unemployment rate is low, the economy is not without prospects for new employment. The labor force participation rate is a source of sustainability for a continuing expansion. The rate is off the bottom and showing signs of stabilizing. Consumer balance sheets are very strong in the aggregate. Total assets have reached new highs, while liabilities are very low. In fact, the amount that debts are costing households as a percent of disposable personal income remains at extreme historic lows. Another thing to consider for consumers is the fact that after 7 years, bad debts fall off credit reports. Access to credit adds fuel to consumer fires. We are beyond the 7-year point from 2008, and consumers have greater access to credit and more spending power than they have had in a decade. Another thing to note about this is that rising interest rates won't have a strong direct impact on consumer balance sheets. Two-thirds of their liabilities are fixed in mortgages, which won't be directly affected by rising interest rates. The federal government's finances have improved from the last number of years. At the peak, the federal government was borrowing more than 35 cents of every dollar spent. However, in the last couple of years, the borrowing rate has grown from a low of about 12 cents of every dollar spent to 17 cents of every dollar now. The long-term forecast calls for borrowing levels to increase going forward and at an increasing rate over recent quarters. It's interesting to note that the Congressional Budget Office expectations for deficit spending do not reflect economists' expectations for higher rates of growth yet. If higher rates of growth are realized, this can help federal finances through greater tax revenues. Only time will tell on that one. Manufacturing indices are extremely healthy. It's not often we see all areas of the world growing robustly at the same time. This shows the breadth and strength of the global economy, and it is stronger this quarter than last. Inflation remains tame, well below historical averages. However, there are areas of the economy with greater than average inflation rates. Unfortunately, some of the higher inflation items like food, housing, and medical care affect everyone, while some lower inflation items like recreation and transportation don't affect all economic participants. The future will likely see a return to more normal rates. If economic growth rates accelerate, higher inflation is likely to be one of the consequences, especially with an expanded money supply. Inflation assumptions can be a starting point for investment assumptions. Starting with low inflation and having it rise is a scenario we've seen 8 times since 1974, and that's the chart in the lower left. In this environment, equities and commodities have been the best performers, although I maintain that the commodities number is skewed by the late 70s, but more on that later. And bonds and cash have not fared well in these environments. Let's talk about interest rates. After falling for the last 31 years, bond yields remain at historic lows. Average nominal yields for the long term have been around 4%. This means that the nominal yield on the 10-year Treasury would have to rise over 1% to just get back to historical averages. The long-term outlook for interest rates is a rise toward the long-term averages. The movement of interest rates will impact bond investors as they watch their values fall. Falling bond values will also make bond holdings illiquid, as asset bids may not match realized results when sold. This is a dangerous environment for bond investors, as rising interest rates may counter coupon payments and remove the reward from the risk-reward equation. When interest rates return to their mean value, how much more can be lost in the bond markets? From current levels, a 1% rise in interest rates will see a 17.3% loss in 30-year treasuries and an 8.2% loss for 10-year treasuries. Those with significant bond holdings, especially treasuries, should carefully consider their asset allocation. Among all bond categories, only convertibles, floating rates, and high-yield securities would see positive returns in this environment, and mostly due to their coupons. So far this year, as interest rates have risen, bond values are suffering. The Fed expects to continue on a path of raising the Fed funds rate. Market expectations show what has already been priced in. There is still some uncertainty with the Fed's ability to follow through in the long term, and there's market conviction in the short term. The Fed has embarked on a program to reduce its balance sheet, which has grown from less than $1 trillion in 2008 to over $4.5 trillion now. Their plan is to cease purchasing assets and then not rebuy maturing assets as they come due. Although announcing a reduction of about $50 billion a month, the actual rate is dependent on the schedule of maturing assets. If they follow this plan closely, it will take about 5 years or more to reach their targets. Another reality check for this plan is the need to maintain liquidity in the debt markets. The Fed will not allow a failed Treasury auction. As long as the federal government continues to borrow with deficit spending, they will continue to issue bonds, and the Fed will be there to ensure all federally issued bonds are purchased to prevent cascading losses in the bond markets. The Fed isn't alone in its plans to reduce central bank balance sheets. The chart on the left shows that central banks expect to reverse the flow of funds fully by 2019. One telltale sign of impending recession is an inverted yield curve where short-term interest rates are higher than long-term rates. Despite flattening over the last 4 years, the yield curve remains positive. Expectations are that the Fed tightening interest rates will also lead to higher long-term rates as well. An inverted yield curve has been a consistent signal of impending recession. So let's talk about the equity markets. Between March 9, 2009 and the end of the first quarter of 2018, the S&P 500 increased by 290%, excluding dividends, and that's a huge increase. There's hardly a period of time that is shorter than the period of time between when the client thinks it's too early to get in and the market analysts think it's too late. Those with a short-term view of history would be forgiven for seeing a market peak at these levels. Consider, though, that we have been through what's known as a secular bear market. There are really two phases when evaluating PE ratios: the secular bear, where PE ratios are contracting, and the secular bull, where PE ratios are expanding. The only way you know you've gone from one to the other is in hindsight. Through the recent secular bear, forward PE ratios contracted from 27.2 times earnings to their current level of 16.4. The yield on the S&P 500 is still competitive with 10-year treasuries. In recent quarters, investors were concerned about high valuations in equities. The price-to-earnings ratio, or the PE ratio, was approaching one standard deviation above the 25-year average. As the S&P 500 has just about held even in a tumultuous fashion in the first quarter, the PE ratio has now reverted back to the average. There are two parts to the PE ratio. Holding all other things static, earnings growth will lower the PE ratio, and we are expecting earnings to continue to grow. The question will always be how quickly stock prices move in relation to earnings. The main reason to invest in equities is the earnings of the companies on the exchanges. Although earnings dropped some quarters ago, they have picked up and resumed their track to record levels. Economists are calling for earnings to continue their rapid growth. This chart shows secular bulls and bears. The secular bear markets are noted by the horizontal lines. It is normal that the markets move to new highs after lows of the PE ratio. It is somewhat cyclical. The average secular bear is about 14 years long, and the most recent started in March of 2000. And is it over? Well, only time's going to answer that question. However, strong market performance shouldn't deter stock investors with a broader view of history. We seem to have broken out of the recent bands of market performance, but that doesn't guarantee a future without significant volatility. There are some rumblings that this bull market is too old and has been growing too long to continue. The reality is that this bull market is neither the longest lived nor the highest flyer of post-World War II equity markets. Bull markets don't die of old age. They end when robust economic growth creates imbalances, which takes a recession to resolve. That is not yet happening in this economic expansion. We are in the fourth largest expansion since World War II. However, we are coming out of the deepest recession at the same time period, with the weakest recovery. There is a lot of room for expansion with growth-oriented policies. The chart on the right shows an economy that has not been performing in line with historical averages. There is room for growth in this economy. As mentioned earlier, strength in the US economy helps to bolster overseas economies. Overseas valuations are more attractive than domestic markets currently. Would you want to go back in time relative to the S&P 500 and invest at lower valuations? Well, that's what's represented overseas. No investment is without risk, and this isn't a sure thing by any means, but the valuations are more attractive here overseas than in domestic markets. Make sure your portfolio isn't too America-focused. Overseas diversification at this time can improve long-term returns. Historically, there have been cycles where domestic equities outperformed international and vice versa. The recent period was one of the longest periods of outperformance domestically. Expectations are for international to lead for the next number of years. These expectations are driven not just by an historical perspective, but also by relative valuations. Trying to forecast the next bear market, let's look at past patterns. Bear markets generally occur in conjunction with economic recessions. In conjunction with recessions, there are usually other factors such as commodity shocks, Fed tightening, and/or extreme valuations. and none of these conditions are prevalent in the current economy and the markets. Few economists are forecasting a bear market for any other reason than it seems to be about time for one. So what should investors do? There is a great deal of cash relative to GDP sitting idle in the economy. The chart on the right shows that over $15.7 trillion remains on the sidelines in various cash equivalent accounts, still higher than last quarter. That is more than both consumer spending and mortgage debts. These cash assets are non-productive assets for growth and a fuel for further investment returns when they are put to work. The chart on the left shows that cash investors, those who invest in CDs also, are getting next to nothing for their patience. Sooner or later, investors have to take some risk in this market in order to make money. Investors in CDs are accepting that they are not coming close to keeping pace with inflation. The main market alternative to stock and dividends is to take on interest rate risk in the bond markets. As shown earlier, bonds aren't a good long-term proposition, in my opinion, if we realize rising interest rates. Over any one-year period, almost any asset class may lead. Over any 5-year period, investors are generally rewarded for investing in equities. Over any 20-year period, there is no comparison. So short-term needs, such as emergency funds, should be funded by investments in short-term assets like cash. Medium-term needs may be rewarded for having a portfolio allocation leaning towards equities, but long-term assets should have a strong leaning toward equities. Diversification and asset allocation do not ensure a profit nor protect against a loss. When losses occur, it takes more than double the growth to recover. The smoother path is managing growth to reduce the losses. Equities are for the long-term investor. On a 1-month or even 1-year basis, returns are as likely to be as positive as they are to be negative. With a 5-year holding period, returns are far more likely to be positive than negative. 10-year holding periods were only negative during the fiscal crisis, and holding periods beyond do not show negative returns for the investor. And the 10 and 15-year holding periods show a pattern we call an M chart. If history is a guide, we may be at the beginnings of another hump in the M, where returns outperform historical averages. It takes courage to invest. Even though the market finished positive 75% of the years in the last 38, the average year saw an intra-year decline of almost 14%. Those who would invest in equities should focus on their financial goals and not react emotionally to every market move. Complacency may become a significant factor as investors haven't experienced historical market volatility for a while. When the markets become volatile, it can be stressful, and investors who only recently began investing may react emotionally. Note that even when the market doesn't finish positively, it never finishes on its low. Selling into a panic isn't a good strategy for wealth preservation nor long-term growth. The dip we've seen so far this year has been about 10%, while the market is currently back to about even. We would all love to be able to invest without risk. If I ever offered someone an investment which would have an average annual return greater than 7% per year, most people would jump at it. Well, that's what the red line represents. What that line really represents, though, is the average annual return of the S&P 500 for the 20 years ended with the bottom of the fiscal crisis, or at the end of February 2009. As painful as the market felt in the dot-com bust of 2000-2002 and the fiscal crisis of 2008 to 2009, the returns for the long-term investor were still fairly robust, even at the worst of it. By the way, why do you invest rather than taking a guaranteed 7% over the long term? This chart shows what happened since the bottom of the S&P 500 to now. Guaranteed returns look good in the worst of times. Over the long term, they create more financial opportunity loss in the portfolio than the short-term volatility of the markets. In this mathematical example, it would take a loss of 50% in the S&P 500 to return to the 7% average line. It's important to note here, though, that the S&P 500 is an unmanaged index. Some successful money managers have seen even better results. When investing in equities, do not ignore the power of compounded returns with dividends reinvested. After 47 years ended in 2017, dividend reinvestment brought a result greater than 4 times the price return alone. For the long term, taking greater risks tends to bring greater rewards. Note, though, that bonds did not keep up with inflation and the rising interest rate environment ended in 1981. All of the positive returns for bonds relative to inflation have come with the falling interest rates environment since then. Dividends are not guaranteed and can fluctuate. A company's future ability to pay dividends may be limited. In the commodity realm, consider the graph in the upper right. Those who bought gold at its peak in 1980 waited until about 2007 to realize a positive return. When factoring for inflation, these investors have still not realized a positive return in real terms. Moreover, recent investors have seen a significant erosion of capital since its peak, greater than one-third of its value. Consider your asset mix. I like to show this chart to demonstrate volatility. Those asset classes which rise the most also fall the most. Another lesson is not to chase returns. What led in growth one year is not guaranteed to lead the next year. In fact, oftentimes the leaders move to the bottom of the class. Maintaining a diversified portfolio has generally worked for the long term. What's on top doesn't stay there, and what's on the bottom will move up again eventually. Volatile asset classes will usually be found at one of the extremes. Asset allocation can make growth a smoother ride for investors. There's another story here. Up until 2008, a diversified portfolio beat the S&P 500 5 out of 7 years. Since then, the diversified portfolio has underperformed the S&P 500 in every year. This can cause investors to put aside diversification in favor of unmanaged indices. Despite recent experience, diversification is still important. In fact, even in this period, the diversified portfolio still has better performance for the long term. While diversification and asset allocation help mitigate risk in a portfolio, they do not guarantee against loss. Where is a good place for investment dollars in the sectors of the economy? Look at the sectors the same way we looked at asset classes and you find a similar story. Those sectors you find on top will one day be on the bottom and vice versa. This chart suggests that a contrarian investor selecting sectors from the bottom of the prior year may be rewarded in the following years. Another method of sector selection is going with the prevailing assumption that future interest rates will be higher than today. In that environment, it would be good to have sectors that are positively correlated to treasury yields. In other words, sectors expected to rise as interest rates rise. On this chart, that would be sectors other than real estate, telecom, consumer staples, and utilities. Financials, especially, are expected to do very well in this environment. That doesn't mean defensive investors should only seek securities in these sectors. They should simply make sure investment portfolios don't neglect holdings in these sectors if they agree with the investment premise. The 20-year annualized returns of available asset classes are shown in the bottom chart. It would be logical to assume that a well-diversified investor would find their own return to be somewhere in the middle of these asset classes, as their returns reflect an average between them. That isn't what we see, though. We find that the average investor has a much lower average return. In fact, at 2.6% per year, the average investor has barely kept pace with inflation over the last 20 years. If they had simply held any one of these other asset classes through the good and bad times, they would have been better off than trying to time the markets. Research shows that working with experienced financial advisors can help investors be consistent, even when it's difficult, and that has helped investment results. I am always happy to review and answer any questions. The disclosure charts can be a bit of an eye chart and hard to absorb in this setting. So if you go to my website, you'll find I have posted the capital markets review in its entirety with the comments, and you can review these as needed. Well, thank you for reviewing the capital markets review with me. If you have any questions, please reach out to me. My contact information is here. Have a great day.